Everybody, Jason Wilson with Ursula & Associates. Welcome back. We're going to be talking a little bit about the 2019 market. It's basically gotten off to a very strong start, especially in the Cherokee-Cobb County area. Things are really pumping along, and part of that is because of the millennials. There's a surge of buyers coming in from the millennial generation that's looking to buy, and some of the chief economists out there are saying that it's going to be boosted even more this year as a result of them starting to form households. So that's what the look and the outcome is. Now, you've probably heard some news about a potential shifting market or a bubble bursting as it did in the past. And although there is some concern of that being out there, it's not all without elements of truth. It's not something that you're going to see a repeat. And that's what most people are concerned about. Are we going to repeat the market that crashed so hard? And if so, why don't we just wait for it to get to the bottom? Well, here's the reality. There is a few factors to a slowing real estate market that are very, very different to what we had before. So the first one's going to be about supply and demand. And that's just your base right there. Is if there's not enough houses to meet the demand of buyer, prices will continue to rise, or at least will hold stable at a bare minimum in this. Number two, rates are historically low. They were set to raise the rates this year, the Fed was, and they ended up not doing it, and they're saying that they're not going to do it for the rest of the year. So you're going to be able to take advantage of still being potentially in the fours all year long and get these excellent rates that there are out there. So supply and demand and rates will drive a lot of this for you. So what's the bottom line, and how does this affect you? Well, two things. One, prices are going to continue to climb. So if you're a seller, now is a great time to be able to sell because rates are low. As long as rates are low, the debt to income ratio is a key factor in how much house somebody can afford to buy. So if your price stays the same and interest rates go up, people that qualified for your house can no longer buy your house if it goes too high from their debt to income standpoint, even though the house value holds. For buyers, the rates are so low, so what you can afford to buy, conversely, is affected as well. So now is a great time to get in because we're not going to probably see a crash like we did in the first time, because back then there were no standards. You could state your income and get a loan even if there was no job verification. And so that's what's different is you still have to qualify. Your debt to income still has to stand. They have to prove that you can afford the house, and they still have to verify that you're employed at the time of closing. These factors contribute to qualified buyers getting into houses versus unqualified buyers, which is what created the bubble last time. Right now, the amount of sales are down simply because there's not enough supply to meet the demand. So it's a little bit of a different dynamic. So if you're going to boil it all down, now is a great time to both buy and sell real estate simply because of that low interest rate being the key factor of what you can afford, and the fact that we're likely, even if the market does shift, to not experience the prolonged shift we had last time. It'll be a little bit more concentrated and normal, what I would call a normal cycle this year. And that's kind of what the economists are leaning towards. They're actually saying it's going to continue to grow and be strong. We all know that adjustments happen in markets. And so I hope you find this information helpful. If you're thinking about selling, give us a call. We'll give you a free, no obligation consultation and go over what those discounts look like. If you're thinking about buying, give us a call and we will take care of you. And there is no cost to our services. Thanks so much.